Hello, how do you do your swing trading daily chart analysis of upward large cap stocks if you are using long up to long swing trading strategy? You open your stock watch list, and here we have a stock watch list, and we are going to analyze those fours, and the first one is JPM. You'll open daily chart. It could either be maximum daily chart or 1 year daily chart, but we are going to use maximum daily chart so that we can see all our support lines, including the lowest one as well, whenever possible. Because on 1 year daily chart, if the stock didn't touch base with a trend line and that trend line is low relative to where the price is, you may not see that trend line on 1 year daily chart. But since our support lines are the lines we like to buy the stocks, we like to see them. Therefore, I'm going to use maximum daily chart, JPM. And doing your daily chart analysis will consist of checking the price. You do your analysis after the market close or early in the morning before the markets open to see how your stock perform during the day. And we are doing the analysis on March 13, 2025 to see how the stock perform on March 12, 2025. And JPM, the price went down yesterday. That's why we have a red bar. And a red bar means the price at the closing of the day was lower than the price in the morning when the markets open. And a green bar means the price at the end of the day was higher than the price in the morning when the markets open. So the price went down that day. Second things you'll do is to compare where the price is to where you want to buy next. If you have not purchased it yet, it's not in a portfolio, the stocks that you are analyzing, you'll want to compare where the price is to where you would like to buy it next. And those are the two lines that we trace to buy it next. We will call them our entry points. And you trace those support lines. In the case of upward stocks, there will be up trend lines. They will pass by the lows of the stocks, going to the y-axis where the price is from 0 up, or going close to where the price is, the current price bar is. And by using maximum daily chart, we can see that these stocks in the past made a wide mountain, and we don't know if it's going to repeat the same thing here or not. So it could touch base with this one line or this one, and which will be the next valley of the mountain. It reached a peak not too long ago and is going down. So we'll want to buy at this trend line or at this one. So and the price is far from those lines in the moment. Therefore, we are not going to do anything with it. So that's how you do your chart analysis. The next one we are going to analyze is KR. And KR is going up. Yesterday the price went down, but again the uptrend line that we like to buy at is still far below where the price is right now. And those are long uptrend lines because they are longer than 1 year time frame. The x-axis is the years or the dates, so those are years bars. or lines, and the price just reached a new high not too long ago and then drop. So yesterday the price went down, but still far from where we like to buy, and these stocks tend to make a tall mountain. So, and this is taller, so at some point it might pull back to here, and that's where we like to buy at. So when you are analyzing your chart to buy, when the price is close to the trend line, that's when you'll pay more attention to see if it's making lower lows or if it's making a higher lows. Higher lows will be to compare the red bar delimited by the green bar, to compare them to each other to see if they are higher. Like this is higher than this, which is higher than this, which is higher than this. So you'll have a trend line that you can trace. Sometimes the green bar can be lower than the red bar. You can use it as well to trace your trend line, but technically I like to compare the red bar that came right after the first green, like this red bar. You can compare it to this one, and you'll notice that this is lower than this one, so there is a lower low here. But if you are and then when you are comparing this low to this one, you have a higher low. So when it's pulling back to the trend line, it will be making lower lows. But then around the trend line, you'll pay more close attention to it. When you start making higher lows and you have about 2 or so, you can buy at the first or second green bar that follow a pullback. But before you buy, it's good to compare how the stocks behave around that trend line previously. Is it just from there go up, or do they do some zigzag there around the trend line? That tells you if you'll have more time to things, to you have more time to wait, or if it's just better you buy some, even that's a little early, after a few pullbacks, after a few higher lows, a decision you are going to make. So when you buy, you'll continue to do your chart analysis as well, comparing where you want to exit. And we can use the next one. The next one is LII. Okay, so LII, we have 3 uptrend lines here to buy at, but it's still higher up, and this is the far up wall of the mountain that is supporting. So to buy it again, we will prefer to buy at either one of those 2 lines down here. So we talk about your entry point. Now we are going to talk about your exit point. So your exit point, once you buy it, you'll aim for the next high, depending on where you bought it. If you bought it at the valley going up, then you can, for upward stocks, you can aim for the next high to be your exit point. So when you see the new high, then you can sell, and you'll have accumulated a lot of profits along the way if you buy somewhere here. For this purchase, that arrow there shows that we purchased it. By the way, yesterday the price went down. The arrow at the bottom pointing up shows where we bought it. The arrows at the top facing down shows where we sold it. So in this instance, we bought it around this trend line, and then we sold it here, which was not a new high, because this is a high here, and the peak that follow were lower than this one. But by buying it here, we have a good amount of profit, and we just got out of it. And the reason why we chose to get out of it instead of waiting for the new high, which in this case was a good idea, was because we realized as the price was moving, we realized that this could well be an upper side wall of the mountain meaning is creating the wall going up to the peak of the mountain, and therefore at any point this trend line could end and it will start working on the descent down to the valley. And for that reason, we just prefer to get out of the trade. And when we purchased it, we were in it. It went all the way here, but didn't reach a new high. And then it pulled back, so we lost that profit. We kept a negative in the account, and it went back up again. And around this area, we just sold it. So, losing that portion of the profit, we just sold it, and it was a good thing because it has not gone up past this high. Since it reached that high, all the other highs were lower, so it could well be getting ready to go down to the valley. So you have to think again about your exit point. Once you buy the stock and you're analyzing your stocks on a daily basis, you'll compare where the price is to where you bought it to where you want to sell it. And when it's getting close to where you want to sell it, you can compare the previous high or how the price move around that area you want to sell it. In this case, the previous high, when it reached it, it pulled back a little bit, went up again and pulled back. So, but sometimes you can see buying it at the valley, for instance, when it touched base with it, it reached a new high along the way every few times, because it's the upward stocks going up. Every increase could be a new high. So if you buy it at the valley here, when it reached the first high, you don't necessarily have to get out of it. If you compare how it behaved previously, you'll notice that it could make multiple highs along the way before we decided to get down. So therefore, if it's going to repeat that same process, you might stay in the trade for multiple highs before you decide to get out. You don't stay in to lock in all the profits, but you just want to lock in some profits that you are comfortable with and just get out of the trade, so that you do not stay in waiting for the maximum profit there is to make and end up increasing your risk to lose it all if you decided to go back down again. But this is what long up-trend and swing trading strategy process is about. So the last one in this same section that we are going to analyze is LLY. LLY is highlighted because we purchased it and we have not sold it yet. And yesterday the price went up. So we have this line that we like to buy at. Next time we buy, but right now the price is far from it, and the price went up yesterday. We bought it multiple times in 2024 using short up-trend and swing trading strategy, but we bought it again shortly after it reached a new high, and it has not reached it since then. Has been on the low side. It went down and went up and went down, so we just kept it in our portfolio until it become positive for us to sell it. So we don't know if it's going to go all the way down to here before going back up again. We don't know, but it'll take a while before we are able to sell it, depending on how long it takes for the price to go back up. And that is an example of why we like to create a watch list of stocks that are good to invest in long term. That way if you buy and the price went down, you can just keep it in your portfolio, turn it into an investment, keep it in the portfolio until it becomes positive and you can sell it for profit. Or when the price goes low, to the valley and start going up again, you might decide to buy more of it. If it comes down here, start going up, we could buy some more of it so that we can accumulate more profits in this one, and when the price is higher up past this one, we can sell all of them. But you'll have to compare to make sure it's going to reach a new high before pulling back to the valley again. If it reach a valley and start going up, you wanted to make sure it's going to, if some stocks will come back to the trend line multiple times before going up, and having one there, if you want to sell it at a price that is higher than the previous purchase, you wanted to consider all of that before you buy it again. Because if you want to sell just a portion of it, first in first out method is going to sell the first one that you purchase. The brokerage firm will sell that one first. But yeah, and behind picking stocks to create your watch list of a certain number of stock in your watch list that you can analyze within an hour, every day after the market close or early in the morning before the markets open, to see how they are performing and see if there is one that is well positioned for you to buy during the day. And if you make a purchase and it became negative, the price went down and it became negative in your portfolio, you just leave it alone until it becomes positive for you to sell it. An example is Microsoft. We purchased Microsoft a while ago and it's negative in our account, but we just leave it there until when it goes back up again, we can sell it. But because we do not like to sell stock at a loss, we prefer to trade stocks that we could easily invest in long term as well. And by doing so, by swing trading those stocks, we just lock in the fluctuation away from the trend line. If you're investing in a long term, you will be accumulating money. You will be increasing your, the money you invested, you'll be accumulating it along that trend line. But by swing trading it, you will be locking in those fluctuations. You'll be cash flowing those fluctuations away from the trend line, but keeping in mind that when you buy it again at the trend line, you'll be paying a price higher than what you paid before, but your cash flow will be higher enough to offset that increase. But that's the way I view it. Prefer to swing trading stocks that I can invest in long term. There is not a lot of profit to make there because you'll be buying it each time at a higher price most of the time. But those stocks, if the price goes down and you leave it in your portfolio, there is a good chance it will become positive again and you'll be able to sell it. Even if it takes more than a year, it will happen. So chances of you losing your money is small, and at the same time you are not going to make a lot of money in a very short period of time with them either. They are stable, they don't fluctuate much, giving you time to practice the strategy you are trying to swing trade with. Just as small, whether it's one share per trade, $300 per trade, $100 per trade. The minimum that the brokerage firm allows you to open your brokerage account with, or your Roth IRA account with if you have a job, and if that minimum is enough to buy one share of stocks, of the stocks you want to buy, is good enough to start with. And you just you lock in some profits, you sell it, and you repeat the process so that you can practice that strategy often, even if that means trading often. To practice the strategy often, fine tune it to customize it to your liking. And at the end of during the year, you can flag stocks that are now well reacting to the strategy you are using. And at the end of the year, you can take them out of your watch list, go back to your master list, and pull the stocks that you didn't trade to replace them and give them a try. And over time, you'll have a watch list of stocks that are well curated to go well along with the strategy you are using. And you just swing trade from that list day after day. Thank you so much for your time. If you are looking for ideas on how to MP stocks to create your own watch list, will you please check the video in the description for the links of the link to the playlist related to those watch list videos. We do have other swing trading related videos cataloged in different playlists, and we have some that we publish already related to the playlist on top, and we have multiple videos related to watch lists, a series of those to show how we create our watch list that we are swing trading this year. And we started recording another series, to show you the whole process, one stock at a time, to see when you to share with you when you come across a stock, how you can put them through those filters to see if they are good enough for you to add to your watch list. Thank you. We thank you very much for watching our videos. We thank you very much for your time. We thank you very much for all your comments. And we thank you very much all that subscribe to our channel. I'm Afiavi Liberman, creator of Liberman Consulting L.L.C YouTube channel, and in asop.com, our blog. On our channel and on our blog, we share different ways to save money and different ways to make money to reach your financial independence, where you do not depend on an employer to provide for your family. And swing trading is one way to make money. Just start small. If you have a full-time job, it's very important you find other streams of income to generate income out beside your paycheck, so that over time you can grow those streams of income to generate income higher than your paycheck. Your high-earned income from your paycheck, you invest it within the stock market, whether to swing trade with, whether in a side business, and the profit from those streams of income support your lifestyle. That is the goal toward reaching your financial independence. And that's pretty much what we share on our channel. Thank you.